Welcome to Learn Commerce PU online classes. Don't forget to like our video and subscribe our YouTube channel for all the updates.
Hello my dear student, welcome back to First Commerce Accountancy online classes. As we discussed in the earlier chapter, we studied the meaning of accounting, the basic concept, basic terms of accounting, and we studied the basic characteristics of accounting and all. Let's start the second chapter of accounting, that is theory base of accounting. See, we know that accounting is a process of, or accounting is concerned with the recording and measuring and analyzing and summarizing and analyzing the business transaction. The main purpose of this accounting is to interpret the results. That information is needed to the interested users to take different decisions. That is what we first studied in first chapter. It is about the meaning of accounting. So we know that accountancy is a language of business. Through that we can receive the different information, which is needed information. That informations are required to take different decisions to the different users. That we studied in our first chapter. See, the thing is, this accounting provides information about the financial performance of an organization, which is required to the different users. Maybe it includes internal users and external users, such as employees, competitors, owners, and different managers of organization, and potential investors, government, tax authority, different sections, different interested users need accounting information to take important decision. That is what the basic information of the accounting. So based on that they can take required decision, needed decision at the right time. So for making accounting information meaningful. See, based on the correct accounting information only we can take correct decision. If the organization is giving true information to the users, then the users can take correct decision regarding any activities of the management, or the other external users also can take any decision based on the reliable information or meaningful information which is given by the organization. So when we are giving the information, say as an organization, if you are giving the accounting information to the interested users, then you should know that then you are giving information, right? That information should be reliable and it should be meaningful. It should be meaningful. Then only internal and external users can take correct decision based on that information, based on the financial information of a company. See, the comparability of information, that we can say that what accounting information should be reliable and it should be comparable. Then only it is considered as a meaningful information. So when based on the meaningful information, any informations can be reliable, or we can believe that we should believe that information based on its reliability, and it should be comparable. It should be comparable. Then only we can call it as a meaningful information. So, okay, the comparability of information is possible. This comparability of information is required to make both inter-firm comparison and inter-period comparison. Inter-firm comparison. So we should make, see, inter-firm comparison and inter-period comparison. These both also very important to an organization. Why this? We know that comparability of information is a basic qualitative characteristics of accounting information. To know the financial performance of one company with another company, we need to compare our accounting information with another organization. To take any important decision or to frame some strategies, we need to compare our one department performance with another department performance. So we need to do both inter-firm comparison and inter-period comparison. Here inter-firm comparison means knowing the performance, or we can say that how the business performance is going on, how the business performance need to be compared with one company with another company. Inter-period means how the business perform is whether it has performed as need to be compared with the one accounting period with the previous accounting period. That both comparison is very important for the organization. Why? We need to frame new strategies, or we need to take some innovative plan, we need to make some innovative plans, we need to take some innovative strategies and all. So to do that, we need to compare our accounting information with another organization, or our accounting information with one department information with another department, or with one department performance with another department performance, like that. So we need to make comparison. So we need accounting information. That information should be reliable, that information should be comparable. So comparability is required to make both inter-firm and inter-period comparison. That is what very important concept in this. But you can raise one question, how we can compare the accounting information, on what base we can compare. So to make, but comparison is possible. Comparison is possible only if the accounting information, or if the information provided by the organization or the financial statement is based on consistent accounting policies, principles and rules. See, to make comparison, or for the comparability purpose, we need to follow the same accounting methods. Say for example, XYZ company is preparing financial statement based on double entry system. Okay, based on double entry system. Then ABC company also should follow the same method for the easy comparison. Easy comparison. So nowadays many organizations, most of the organizations are following only double entry system of accounting. So we should know that we cannot record the transaction blindly. We can record the transaction. We can record the transaction with the following some rules and regulations. We need to follow some of the rules and regulations which is given in the generally accepted accounting principle. That is the next concept. We need to study that concept also. So we can record the transaction in the books of accounts based on some of the important concepts, based on some of the rules, principles and all. Okay, so here we can say that information can be compared if the organization is preparing financial statement based on the consistency method, or based on the consistent accounting policies or procedures or principles and practice. Each and every organization need to follow the same method to prepare the financial statement. They need to follow the principles, consistent uniformity principles to record the business transactions. Purchase, say for example, today number of purchases are taken up, or the number of selling activities are took up by the organization. Then how they can record the sales transaction, how they can record the purchase transaction. Already when we are discussing about the debit and credit concept, there we studied that each and every transaction affects two different accounts, minimum two different accounts. Maybe some transaction may affect more than two accounts also. But according to the double entry system, each and every transaction affects two different accounts. Then we need to record that one particular transaction in two different accounts. That is what the same some of the methods or assumptions which are followed by the accountants or the professions. That method should be followed by each and every organization for the easy comparison purpose. So such a consistency is required throughout the process of accounting. So, to maintain uniformity or to maintain consistency in the process of accounting or at the time of recording the transaction, we need to follow some of the rules and regulations. We need to follow some of the rules and regulations throughout the process of accounting. See, the theory base of accounting consists of principles, rules and some guidelines. It consists of principles, concepts, rules and guidelines. The theory base of accounting consists what? Rules, principles, some of the principles and some concepts and general guidelines. These rules or principles have developed over a period of time to bring, the main purpose of these are to bring uniformity in the process of, to bring uniformity and consistency in the process of accounting. So to bring uniformity and to bring consistency, we need to follow some of the rules to record the transaction. We need to follow some of the principles to record the financial transaction, to prepare financial statements. We need to follow some of the concepts to record the transactions, and some guidelines and some assumptions are given, have developed over a period of time, and these are freely accepted by many the professionalists. These rules and procedures or principles are helpful to the business person to record the transaction and to prepare financial statement. That is what the very important concept in this chapter. And the Institute of Chartered Accountant of India, the Institute of Chartered Accountant of India, Chartered Accountants of India, ICAI, the Institute of Chartered Accountants of India, which is a regulatory body which gives which is a regulatory body for the standardization of accounting policies in the country, which is a regulatory body for the standardization of accounting policies, has in the country, has issued some of or given some of the accounting standards to bring uniformity and consistency in the process of accounting. So ICAI, in the exam point of view, it may ask for 1 mark question, expand ICAI, or which is a regulatory body for the standardization of accounting policy in our country. In our country, Institute of Chartered Accountants of India is a regulatory body for the standardization of accounting policies. These developed or introduced some of the accounting standards to bring uniformity and consistency in the process of accounting. Getting my point? Next, move on to the next topic, that is what? Generally accepted accounting policies. Generally accepted accounting policies. In short, it is called as GAAP. This one also for 1 mark with very important, expand GAAP, that is what? Generally accepted accounting principles. Here already I told that in order to bring uniformity, some of the rules and some of the concepts or guidelines have been developed over a period of time, and these are all accepted by the accounting professionals and all. This one also, in order to maintain uniformity and consistency in the process of accounting, some certain rules or principles have been developed which is generally accepted by the accounting professionals. These principles or the concepts or some of the guidelines have developed over a period of time, and these all rules, all concepts are accepted by the accounting professionals. That is what generally accepted accounting principles. These rules are called by different names, such as it may called as principles or concepts, conventions, postulates, or it is also called as assumptions. These all these concepts or the generally accepted principles are called by different names. What are those names? It is called as principles, or it is also named by concepts, conventions, postulates, and it is also called as assumptions. Assumptions means what? Some ಊಹೆಗಳು ಅಂತ ಹೇಳ್ತೇವೆ, assumptions. Okay, so these generally accepted accounting principles refers to the rules and guidelines. These are refers to what? Rules and guidelines. These are the important rules and guidelines which is adopted, which is required. These rules and guidelines are required for recording and reporting the financial transaction. The thing is, you should know that is, we know that accounting is a function or it is concerned with the recording of financial transaction. Okay, we all agree this. Recording the financial transaction is the first and foremost function of accounting. Okay, but how we can record the transaction? Can we record the transaction like this? On 1st January, purchase 10,000. On 2nd January, sales like 10,000. Like this, can we record the transaction? It is an insystematic recording of transaction. We need accounting, financial information at the end of the time, at the end of the month or quarterly. We need accounting information, financial information. But to get financial information, we need to prepare the accounting information, means we need to prepare the financial statements. We can prepare financial statement based on these records, based on the records which were the initial record of accounting transactions and financial transaction and all. So for that reason, we need to record the transaction in the books of accounts in a systematic manner. Each and every transaction affects 2 different accounts, so we need to record each and every transaction in 2 different accounts. We need to follow journal, we need to pass journal entries. After that, we need to post that journal entries into ledger. These are all what? Some of the procedures, some of the principles or some of the rules of the accounting. Already these rules or these principles have developed by our senior accounting professionals and all. We need to follow that concepts to record the business transaction. Then only we can find out exact accounting information. We can find out the exact position of an organization. So these are the rules and guidelines which are required at the time of recording and reporting the financial transaction. Recording and reporting the financial transaction. That is what? In order to bring uniformity and in order to bring consistency in the process of accounting, we need to follow the generally accepted accounting principles. We need to understand the basic accounting concepts. We need to follow some of the rules and general guidelines to record the transactions. Then only we can pass the simple journal entry, then only we can prepare the financial statements. That is what the basic concept of accounting. Got it? Getting my point? So for example, we need to why we need to follow these gaps or these general accounting principles? Because all transactions are recorded based on its historical cost. Correct? Based on the historical cost. See, all transactions are recorded in the books of accounts based on its receipts, based on its documents, evidences, based on its vouchers and all. So we cannot record the transaction, we cannot record the future transaction. Tomorrow this much transaction may happen. We cannot record like that. What the transactions are took up in an organization, that transactions only recorded in the books of, can only record in the books of accounts. That is what business record the transaction based on its happenings, past happenings and all. Okay, events are already agidda transactions galanna record madodu. That is what very important here. So these gaps have evolved over a long period of time. The generally accounting principles are the not new concept. It is not introduced in a recent year. It has evolved over a long period of time, and these principles are not static in nature. They are constant in nature. It means what? They can be modified with the changes in the economy. They can be modified. They can be influenced by social, legal and political environment. Okay, influenced by political environment, they can be influenced by legal factors or some of the social issues, and also as well as we can say that these principles can be modified with the needs of the users. With the needs of the user. These are not static in nature. That is what very important. These are constant in nature. They can be modified with the changes in the economy. That is what very important. And these principles are also called as concepts and conventions. These are also called as what? Concepts and conventions. Conventions. Student, if without knowing these concepts or conventions, we cannot pass the single journal entry. The single journal entry. We cannot pass the journal entry for purchase of goods. We cannot pass the journal entry for sale of goods, because to record a single transaction, we need to follow some of the rules. We need to follow some of the assumptions. We need to know some basic concept, basic principles. Based on that principle or based on that rule, only we can record the transaction in the books of accounts. That's why these are also called as some of the assumptions. Say for example, this is also known by concepts and conventions. Here concept means what? These concepts, the term concept refers to the necessary assumptions and ideas which are fundamental in the process of accounting or in the accounting practices. These concepts are also called as what? The term concept refers to what? The basic or the fundamental assumptions and ideas, but these assumptions or ideas are fundamental to the accounting practices. To pass a single journal entry or to pass simple journal entries, we need to know, we need to study concept. So these are all the basic assumptions and ideas. These assumptions and ideas are fundamental to the accounting practice. Then what exactly conventions? So the term conventions refers to the basic or the customs and traditions which are needed, or these are as a guide, these customs or traditions as a guide to the preparation of financial statements or to preparation of accounting statements. We need to follow some of the customs and traditions. These conventions are the basic traditions or the basic customs which are required to prepare the accounting statements. So this is about concept and conventions. The next main topic in this chapter is basic accounting concepts. What is that? Basic accounting concepts. Dear student, this topic is very interesting topic, because by learning this topic, by learning this concepts, we can get more and more knowledge about the concept of accounting. We can try to pass journal entries, We can try to understand what are the two different accounts can be affected by a single transaction and all. So this is what the very basic and fundamental concepts in our accounting, because based on these concepts or based on these principles we can study the number of concepts in accounting. Without knowing these concepts we cannot pass single transaction also, simple transactions also. Getting my point? So the basic accounting concepts are referred to as the fundamental ideas or the basic assumptions. These are all what? The basic ideas or the fundamental ideas and assumptions of the theory and practice of financial accounting. These are the basic or the fundamental ideas or assumptions of the theory and practice of financial accounting. These are the basic assumptions and basic ideas of the fundamental accounting, the practice and fundamental accounting. And we need to know that there are 13 concepts. There are basic or the main 13 accounting concepts are there. They are, here I will write one by one. The first important concept is business entity concept. Business entity concept. The second one is money measurement concept. Money measurement concept. And the third one is accounting period concept. Accounting period concept. And the fourth one is going concern concept. Going concern concept. And the fifth one is cost concept. And the sixth one is dual aspect concept. Dual aspect concept. And the seventh one is revenue recognition concept. Revenue recognition concept. And the eighth one is matching concept. And ninth one is full disclosure concept. Tenth one, consistency concept. Conservatism concept. Next one is materiality concept. Materiality concept. And the 13th one is objectivity concept. Objectivity concept. See, total 13 concepts are there. Based on these concepts we can pass the journal entries, we can study the basic accounting informations and all. So we need to study these 13 concepts in deep in this second chapter. So all these concepts are very important concepts. From next class onwards we will study these concepts one by one. What exactly business entity concept or what is money measurement concept, like that. So now take down the assignment question. Expand GAAP. Which is it is an important question in this chapter. For 1 mark, expand GAAP. Thank you for watching this video.
Don't forget to like our video and subscribe our YouTube channel for all the updates.